Most people have heard about Warren Buffett, the Oracle of Omaha, and how he became one of the world's richest people as an investor and chairman of Berkshire Hathaway. But alongside him for the past 60 years, 45 of which as vice chairman of Berkshire Hathaway, is another extremely successful investor that there's a lot to learn from, Charlie Munger. Most of what you know of Charlie Munger is probably after he partnered up with Warren Buffett, but in this video, we're going to dive into Charlie's early years as an investor and look at how he managed to reach his first $1 million. Unlike his friend Warren, who had a straight and targeted road to his first $1 million, Charlie's road was a bit bumpier. This is investing in a nutshell. Charlie Munger and Warren Buffett both came from Omaha, and they both grew up in upper middle class families, but neither of them inherited any money that gave them an early start. They had to create their own wealth. Charlie was born on January 1st, 1924, and it would take 35 years before he met Warren for the first time, but more on that later. Already at age 12, he started working for Warren's grandfather, Ernest Buffett, in his grocery store. Ernest was a tough boss and made Charlie work 12-hour shifts for $2. Even in the 1930s, $2 a day was not a lot, and it taught Charlie the important lesson that there had to be easier ways to make money. Charlie didn't start his investment journey as early as his future friend Warren, so let's jump ahead to when Charlie graduated from Harvard Law in 1948. With a grandfather that was a judge and a father who worked as a lawyer, it was no surprise that Charlie also started practicing law in his early career. He was, as he said, born into it. He passed the California bar and got a job at the firm Wright & Garrett in Los Angeles with a starting salary of $275 a month, which was a bit more than the median income at that time. At this point, he had managed to save up $1,500. As an attorney, Charlie made a lot of valuable acquaintances with customers that gave him different investment opportunities. In the early 1950s, he had a client named Ed Hoskins who owned a business that made specialized transformers for military equipment. The company was called Transformer Engineers and had seen a huge rise in demand due to the ongoing Korean War. There were, however, disagreements between Hoskins and his investors, and Charlie saw it as an opportunity to invest in the company. Soon after the Korean War ended, the demand tanked, and so did Charlie's investment. It took him almost 10 years to get out of the position with a small profit, but it taught him a valuable lesson that you should not invest in companies without long-term business plans. Warren Buffett also made a terrible first investment in his life, which we covered in the video about his road to his first $1 million, so make sure to check it out when you're done with this one. Charlie got married at the age of 21 to Nancy Huggins, but after only 8 years in 1953, they got divorced. The divorce turned out to be Charlie's biggest financial and emotional setback. Nancy kept the house and children, while Charlie moved into a bachelor apartment. On top of the divorce, soon after Charlie and Nancy's son got diagnosed with leukemia, and in the 1950s, that was essentially a death sentence. The medical bills didn't get covered by any insurances. And even though they tried everything, their son died in 1955. Most people would probably never recover after such an emotional and financial setback. But Charlie would not let one tragedy turn into more tragedies, so he pushed on forward. In 1959, Charlie and Warren met for the first time at a dinner party back in Omaha. They immediately hit it off. In the video about Warren, we looked at Charlie's influence on Warren's cigar butt strategy. So in this video, we'll focus on Warren's influence on Charlie. Warren was in fact probably the person who got Charlie to leave law and start investing full-time down the road. Warren told Charlie that law is fine as a hobby, but I think you can do better. It took, however, almost 2 decades before the two of them ended up together as chairman and vice chairman of Berkshire Hathaway. How do you think Charlie invested in order to reach his first $1 million? I bet most of you think it was through stock market investing, but it was in fact in real estate. In the beginning of the 1960s, Charlie had a client named Otis Booth. Otis Booth's grandfather had owned a property close to the California Institute of Technology in Los Angeles, and his father didn't think they had any use of it, so he wanted to sell it. Otis hired Charlie to handle the probate settlement, but instead Charlie advised Otis to keep the property and build new apartments there. Charlie had noticed that land development was an extremely profitable business due to the explosive growth Los Angeles had at that time. Otis countered Charlie that if he thought this was such a good idea, he should add his own money to the table and do it with them. So he did. It took them some years to finish the project, but in 1967, they sold the unit and made $500,000 from their initial $100,000 investment. In the meantime, Charlie had also started 2 other development projects with his friend, Al Marshall. After finishing the first project with Otis, they too went on for a second project together. All these deals made Charlie a lot of money, but more on that in a bit. It was during the first half of the 1960s, when Charlie started doing real estate development, that he quit his job as a lawyer. At this point, he had a net worth of $300,000, and approximately half of that he made through his investments. But before he went all in on his investing career, he started a law firm in 1962 called Munger, Tolles, and Olson, which even today is a very successful law firm. The same year, he also started his first investment partnership, called Wheeler, Munger, and Company. The partnership lasted for 14 years and had an incredible annualized return of more than 19%. In the same period, the S&P 500 only had a 5.9% annualized return. This overperformance of the S&P 500 is even greater than what legendary investor Peter Lynch managed with his Fidelity Magellan Fund from 1977 to 1990. Charlie was not afraid to leverage his positions in the partnership, making the bear market at the beginning of the 1970s some extra tough years, even though he overall crushed the market. This would be impossible with the amounts of money Berkshire Hathaway is working with. It might sound crazy that having an investment portfolio of several $100 billion has its disadvantages, but it is actually the case. Let's imagine there's a new startup company that Warren and Charlie truly believe will outperform the rest of the market. The hypothetical company has a market cap of $100 million. Even if Berkshire bought the entire company, it would still be an investment of less than 0.1% of Berkshire's portfolio, and therefore most likely not to have a sizable impact on their portfolio investment. Because of this luxury problem of having too much money to invest, leveraging positions just wouldn't make any sense. As a smaller investor with a portfolio of, let's say, $10,000, you would be able to go all in or even leverage your position to $20,000 or $30,000. So, when did Charlie Munger become a millionaire? Well, after finishing all his real estate developments in 1969, his net worth was around $1.4 million. So we can assume he became a millionaire some years before that. At this time, Charlie was in his early 40s. Luckily, he hadn't made the same childhood bet as Warren Buffett. If you don't know what I'm talking about, check out our video about his road to $1 million. But first, here are my 3 most important takeaways from Charlie's road to $1 million. 1. The importance of networking. Many of the most important investment opportunities Charlie got, he got through his job as a lawyer. I'm not saying you should start studying law to become a successful investor, but what you can learn from it is the importance of meeting the right people with the right mindset to influence you and inspire you on your investment journey. I myself would never be where I am today as an investor if it wasn't for many of the people I surround myself with and make business ideas and projects with. Where do you meet the right people? That can be anywhere. The easiest way to find other investors and entrepreneurs is to study the field yourself, go to seminars, or reach out to people online and show your interest to your friends and family. Maybe you already have friends that are trying to achieve the same things as you. If people know you are into investing, people might reach out to you as well. 2. Real estate as an alternative to stock market investing. Charlie Munger is most famous for his work at Berkshire Hathaway, together with Warren Buffett. But what made him the most amount of money in his early days was in fact real estate development, and not stock market investing. Real estate is usually a bit more active investing than investing in stocks, but it can be a great way to rapidly increase your net worth. One of the great things about real estate is that it's usually easy and cheap to leverage your deals with low-interest mortgages. That way you might only need a small amount of equity yourself to get started with your first deal. If you manage to get a 10% profit on an investment you only have 10% equity in, It means that you have doubled your money. This level of leveraging can be done in real estate, but should never be used in the stock market. That brings us to the final takeaway. 3. The power of leverage, if used correctly. Leverage can be a dangerous tool and has made many investors go broke beyond the point of no return. But it can also be an extremely powerful tool that can accelerate your portfolio growth tremendously. If you're just starting out with investing, chances are that the amounts you invest is relatively small compared to your income. If that's the case, you might afford a higher risk than if you're investing your entire retirement portfolio. The earlier in your investment journey you are, the more likely you are to be able to get back from major setbacks. That being said, you should always have a plan when using leverage. For example, you should never leverage positions that can cause serious financial struggles to you or your family if things go wrong. To lose everything you've invested is painful, but to end up in debt because of investing can ruin your finances for the rest of your life. You should always have a plan when using leverage. What do you do if your investment goes in the wrong direction? Do you have other safer assets in your portfolio that you can use to rebalance your portfolio? Is it too risky to leverage positions in individual companies? Should you maybe rather use leverage in broader markets or indices? Or maybe in real estate? These are all questions you should ask yourself before using leverage. You always need to do your own research and find your risk tolerance. But we'll help you with as much knowledge as possible. So make sure to subscribe to the channel so you don't miss out on any future content. We hope you've enjoyed this video and that it's inspired you on your own path to your first million. If you have any questions or feedback, leave a comment. We'd truly appreciate a thumbs up if you've enjoyed this video. See you in the next one.